Hello, my name is Ron Lusberg, and I'm a senior consultant with Counterpoint Payroll and HCM. We're here to speak with you today about the benefits of a great retirement plan and a plan design that brings maximum benefits to business owners. Counterpoint Payroll and HCM offers the unique combination of state-of-the-art technology along with best-in-class customer service. We're a company made up of experienced, knowledgeable industry professionals, and every one of our clients gets a one-on-one relationship with a dedicated client service representative. At this point in time, I'd like to introduce Denise Herrick of Snap TPA and Steve Puckett of FPP, who will be presenting today's brief webinar.
Thank you very much, Ron. Hello, my name is Steve Puckett with Fiduciary Pension Partners. And again, we have Denise Herrick with Snap TPA. We just want to share with you in this quick webinar some fantastic retirement opportunities, not only to save taxes, but also help your employees and owners retire. So with that, I will turn it over to Denise Herrick to talk about cash balance pension plans.
Hi, good morning or good afternoon. One of the nice things about a cash balance retirement plan is that it gives you an opportunity to put away more money for your retirement than you're able to get in a traditional 401k plan. When you pair a cash balance plan with a 401k plan, you get even more benefits. What we like about the cash balance plan and where it works best is for an older owner with younger employees, because the benefits in a cash balance plan are balanced. The intention is to get to a point where every year a certain amount goes in for your benefit in the cash balance plan, and it grows at a certain interest rate so that you can see it grow almost like you see your bank account grow or a 401k plan grow. And even though there is a defined benefit component involved where we're shooting to provide you with a monthly benefit when you reach your normal retirement age, whether that's 60 or 65, it also easily converts to an account balance type of situation where you can see your balance ongoing every year. Depending on your situation, we design the benefit formula, we design the contributions around your own retirement objectives. Whether your retirement objectives are to grow the benefit as fast as possible, or whether you want a slow growth over a longer period of time. Typically, a cash balance plan is set up with the intention of being a benefit to you and your employees for about 5 to 10 years. Sometimes the benefits are fully funded after 5 years, depending on, again, on your own retirement objectives. It could take 10 years to fully fund the benefits. The advantages of a cash balance defined benefit plan over a traditional defined benefit plan is that you actually get to see an account balance, which is a little bit more complicated in a traditional defined benefit plan. And when you're ready to retire or take your money and roll it over, you've got options. You can take the money out of the plan in the form of a monthly annuity. You can cash it out as a lump sum payout. You can roll it over to your existing 401k or profit sharing plan. You can roll it over to an IRA. In certain instances, the benefits in a cash balance plan are guaranteed by the Pension Benefit Guaranty Corporation. But if you are a professional service organization, let's say an accounting firm, a doctor's group, a lawyer's group, you would be considered a professional service organization, and you do not have to be covered by the Pension Benefit Guaranty Corporation. The nice thing about it, if you look at this chart, and you want to know or tell your clients, how much can I put away in a cash balance plan depending on my age? Well, if you're 50 years old and you make, let's say, $245,000 a year, we can get you a contribution of $195,000 a year. If your tax rate is 35%, that's a tax rate savings of $68,250 with a contribution going in for you for $195,000. But let's say you're 50 years old and all of your employees are between 20 and 40 years old. You still get that $195,000 contribution to yourself, but you're giving your employees somewhere between 3 and 5% of pay as a benefit. There's certain non-discriminatory non-discrimination tests that have to be passed in order to enjoy the benefits of this type of plan. But that's something that SNAP TPA can do for you. We'll ask you for a copy of your employee demographics, dates of birth, dates of hire, years of service, compensation, hours worked in a year, and then we design a plan that best meets your needs.
So Denise, this cash balance would be on top of their 401k plan?
Sometimes it's beneficial to pair it with a 401k plan, especially when you have employees, because there are certain minimum benefits that you have to give to the employees regardless of the type of plan you have. And it's more cost effective to give those minimum benefits in the 401k plan than it is in the defined benefit or cash balance plan.
Great. So this could be on top of their profit sharing plan, 401k plan. And it sounds like it would be for those companies that do have significant profits. Because obviously, to make these large contributions, you would want to, have a very profitable company.
That is true. And unlike a 401k plan with a profit sharing component, profit sharings are always discretionary. You don't have to make them, but you can make them up to certain limitations. In a cash balance or even a traditional defined benefit plan, those are mandatory contributions, and you're making a commitment every year to put those contributions in. So it's not something you want to set up when you have when you know you're going to have 1 year of a good year, but then you're going to go back to, your normal income. And this is for growing companies that are expecting large profits going forward.
Perfect. And it seems like the perfect client would be one that has older owners and maybe younger staff. Someone like a dentist practice or a doctor's group or a law practice. Is that right? Or could it be anyone?
It actually works better when you have older owners, younger employees, but there are situations where you might have highly competent, like let's take a dentist office where you have 4 or 5 dentists working there, but only one dentist owns the practice. The other dentists are considered highly compensated because their income is above a certain level. In certain instances, you can do lower benefits for those other dentists while maximizing the owner. And that helps with the non-discrimination testing. So if you do have some older, a mixture of employees, some older, some younger, but you've got more than one highly compensated employee, you can skew the benefits so that they go to the owner. And you keep the contributions to the employees and the other HCEs at a lower level in order to pass certain non-discrimination testing.
And so I imagine what a prospective client of Counterpoint would do is if they give you the census of the company, that would allow you to do an analysis to figure out whether it is a good fit for cash balance or not.
That's exactly right. And there are some instances when we tell them that you don't need a 401k plan. It doesn't give you any added benefits. Most of the time it does, but at that point you're running 2 plans. So again, depending on the company and the company's needs, we make the recommendation.
Fantastic. And again, I imagine, for those companies that are a right fit, this could be a huge savings, not only from a tax shelter standpoint, but also from a retirement standpoint for those owners.
Yeah, good point, Steve. That's exactly right. Again, like with a 401k plan, the contributions you're putting in are tax deferred. You enjoy the tax deduction this year, but at some point, those benefits, when they come out of the plan, will be taxable, whether they're taken out at retirement age or whether they're taken out at required minimum distributions when you reach age 73 or 74 down the road.
And from an administration standpoint, that's the one thing that I hear from our small business owners is they don't have an HR staff. They don't have, people to help out. Is there a lot of work needed to be done on a cash balance plan?
Not that much more work than is involved in a 401k plan. Again, it's a matter of gathering the right data and having the information to be able to run end of the year numbers. An actuary is involved. We need an actuary to calculate the contributions into a cash balance plan, and the actuary certifies the amounts that do go in and work with us. Cash balance plans are a little bit more expensive to administer than a 401k plan. However, the tax savings is more than the administrative costs.
So again, there is that annual filing and there is a little bit of administration work that's needed, but I assume that a lot of that is put on the hands of Snap TPA.
That is true, yes. And SNAP TPA will guide you or your employees through what needs to be done to maintain your plan in compliance with IRS and Department of Labor rules and regulations. We keep your plan documents up to date. Basically, what TPA's job is to dot the i's and cross the t's, and we act as a watchdog. We make sure that you and your employees are doing what you need to do to maintain the plan. We work with fiduciary pension partners to make sure that the money is getting invested where, you've decided that it should be invested. And we also work with the actuary to make sure everything is done at a professional level and maintained.
Well, fantastic. Thank you very much, Denise. And I'll just wrap up. Again, Fiduciary Pension Partners, we're your independent consultants to make sure everything works smoothly. We work very closely with the Counterpoint HCM to make sure payroll, benefits, 401k, cash balance all work smoothly. So again, we're your independent advocates to make sure that you are receiving the best benefits and the most tax efficient of those benefits. And again, just as a disclaimer, SNAP TPA, Counterpoint HCM, Fiduciary Pension Partners, we are all independent organizations. And again, these view points that we have are ours ourselves. Do not take this as tax advice or any legal advice. And again, if you need any help, we would be more than happy to help out. Have a great day.